How are markets reacting to last week's decision by the Federal Reserve to keep interest rates flat for the time being? And just how is that impacting you, the consumer? Welcome back to the States. I'm Greg Bishop. For Everyday Economics this week, I talked with PhD economist Orphe Divounguy earlier this morning to push past the headlines and to delve deeper into what the Fed's decision last week means for your pocketbook. Orphe, the significance of last week's rate being held steady by the Federal Reserve. Listen, they've done this for 5 straight meetings, but what was different about this past week's vote?
Yeah, I think the lack of guidance. The new Fed chair does not really believe in the Fed telling markets what the Fed will do. The Fed chair wants markets learning to play the ball, not the referee. In other words, try to interpret the data and then decide what to do based on the data, as opposed to what the Fed is telling you the Fed could do in the future. But that creates a ton of confusion, right? The response, the market reaction was stops falling 1,150 basis points on the day. The 30-year Treasury yield jumped to its highest since 2007. It means basically markets interpret that there's more inflation risk if the Fed is not really ready to react to what appears to be stubborn inflation.
Yeah, and you've got the 5 past meetings, them keeping rates flat, but the vote this past week, it seemed to send some signals. You had 3 on the board there that decided that they wanted to actually go not down, but up.
That's right. You mentioned the 3 dissents. That's the first time we've had 3 dissents in the same direction. Now you have, Beth Hammack of Cleveland Fed, Neil Kashkari of Minneapolis, and Lori Logan of Dallas, all opting for a rate hike. Well, why? Because inflation remains stubborn, because the labor market looks in okay condition at a 4.2% unemployment rate. And so, Karen Warsh, talked about, a Fed that is going to respond to the data, and yet the Fed did nothing that the data really implied it should be doing right now. And so the market responded by basically implying that inflation could run hotter under this new Fed. So that's what we got last week. And that could be problematic ahead of this week's jobs report. It seems that the markets will respond and that volatility will increase in the absence of Fed guidance.
You write there's a couple of layers to answering the question of how we got here, right? Where the signals are indicating that we could possibly see interest rates go up before the end of the year. So talk about that kind of surface level headline layer of answering that question of how we got here, and then go into that deeper level of, the inflation concerns and what's going to be driving that.
Yeah, and I mean, we got inflation expectations have moved up a little bit. We got, we have basically a big demand for investment. The AI spending, that's a big factor that's going to continue to push interest rates higher. We also have lower. On the opposite side, we got lower population growth, right? And lower population risk will push interest rates lower. And so you have all these factors that are shifting that will have different impacts on what economists call the neutral rate. And so that's kind of the picture. But then you also have fiscal deficits. A fiscal deficit will push rates higher. So those are the factors that are at play here. And the combination of those factors basically imply that interest rates could have moved higher on net. And that's what we're likely going to see. Now, the Fed hasn't responded yet. I think there are different school of thoughts here. You have people at the Fed that believe that, interest rates could move lower. But I think the fact that we have more and more dissents and that more and more people are opting for higher interest rates tell you basically that more people at the Fed are starting to think that potentially interest rates, that Fed policy may not be restrictive enough. And so I happen to think it could be just barely restrictive. But ultimately what that means is cuts are completely off the table.
Now, you mentioned the jobs report expected later this week, and a lot of people are going to be watching that closely. How does last week's vote by the Fed to keep interest rates steady, how does that impact what we could see coming up Friday with that jobs report?
Yeah, I think ultimately it's the lack of guidance, right? No forward guidance, the Fed not telling us what it's going to do. No framework guidance, the Fed basically not telling us how it thinks about the data and how it reacts to the data. And all of that creates uncertainty, right? And that uncertainty will show up in higher volatility. You know, in the absence of the Fed, a forward guidance and the absence of framework guidance, I think every number will hit much harder than it used to. A acceleration in wage growth will likely push yields much higher than they would have had the Fed basically guided markets and told markets how to think about the data and what it could do next, right? So that's what I'm looking for. I'm not really looking for the number itself, but the market reaction. I think regardless of what that number is, expect larger volatility when those numbers hit on Friday.
Oh, and finally here, Orphe, how does this look for those in the jobs market, those looking to save for retirement? What's the bottom line for consumers?
Higher volatility is never good, right? Higher uncertainty keep businesses from hiring workers, right? If you don't know what's going to happen next, you kind of hold back, you sit tight. You hold on to your wallet, you sit on your wallet, you don't go out and make big purchases or big investments. And so higher volatility is never a good thing. For people sitting near retirement, the big stock market drop we got last week, yes, the stock market recovered, but the big drop is not a place where they want to be. It doesn't feel nice. You rather see your portfolio continue to climb right into your retirement years. To finance your consumption, to pay your bills, essentially, right? And so higher volatility is never a good thing for long term, for people who are sitting, for households, people who are sitting on the sidelines hoping to get a job next week, for retirees or people close to retirement who don't have a lot of time left to save up and see their portfolio increase, right? And so that is what's at stake here. Really what we need is a Fed to come back with a reaction function, a Fed to guide markets and tell them this is exactly how we will respond based on the economic data. And I think this Fed chair just hasn't done that quite yet.
Yeah, it's interesting. What he could do to help the markets, he's saying, no, I want the markets to just look at the numbers themselves and interpret it. It's a fascinating dynamic. And
the markets really need to know how the Fed also interprets those numbers. That no forward guidance is one thing, but a reaction function, some clarity as to how the Fed reacts to the numbers or should react to the numbers is important, and that's missing. It's that concept of framework guidance that Warsh has been talking about. Unfortunately, he hasn't been forthcoming yet about what that actually looks like.
Well, it's just some of the valuable insight you get here with Everyday Economics. So be sure to subscribe for more here from the Center Square. I'm Greg Bishop. Dr. Orphe Divounguy, greatly appreciate your time as always.